All righty, welcome to week 7. And in week 7, we're going to go again to course content. Module week 7, you have your reading and studies of chapters 11 and 14, all the presentations there. We're going to go to the learning activities and assessments. This week, we're going to be discussing the contingent liabilities, which we'll get into a little bit more detail. But I will say on the discussion board, if you do not reference Acct or IFRS and put it in the APA format, you will lose points for the support, okay? Because you're having to answer a question on whether or not you're going to record a liability, and in order to answer that, you need to be able to state why you're answering that, okay? In there, you also have the Learn Smart assignments. I've also created the extra credit assignment here for you to be able to drop in for those that are participating. The details, again, are copied here for anybody that would like. And then we're going to get into the homework 7. So again, this week we're talking about liabilities. The definition of a liability is any debt that we will have to have an economic payment sometime in the future for current circumstances. Okay, I know that's a lengthy definition, but the point is, if we're going to have to either pay money or do work or anything in the future because of something that's happened up to this point, then we're going to have to record that as a liability. And we'll classify it as short-term and long-term based off of typically a 12-month period, but we call it within one reporting period, which is usually 1 year or 12 months. Okay, so there's a few different liabilities that we're going to be talking about on the homework. Each one that comes up, make sure you have a flashcard of the definitions. There's 2 in particular that we wanted to talk about that are a little bit more complicated than the other straightforward ones. The one for your discussion board is what's called a contingent liability. So what that means is that it's based off of something that has happened today, but it's contingent upon something else happening in the future in terms of being able to actually determine whether or not a future payment will be made and for how much that payment is going to be made. Now, when we talk about contingent liabilities, the most used example is going to be a pending lawsuit. So with the pending lawsuit, whatever the outcome of that lawsuit is, the reason that lawsuit is going on today is for something that has already happened up until this point. And so typically your matching principle states that you need to match that expense with the revenue that was already generated during the time of which that event occurred. The problem with that is that we don't know what's going to happen to the lawsuit. It's contingent upon whether or not the judge decides for us or how much the judge decides during that lawsuit. So there's something that still needs to occur in the future, but yet it is based off of events that have occurred today. And so when we talk about contingent liability, we have a estimate that's going to come up on whether or not to record this. And again, all of this is going to be based off of 2 factors. One, how likely is that event to occur? And 2, can we reasonably estimate how much that expense is going to generate? Now, GAAP and IFRS still differ on this, so you're going to have to use your book to determine which is appropriate. And we're going to typically get advice from our legal department on how probable the situation is. So we're going to ask them, hey, during this lawsuit, what do you think the outcome is going to be? And if you've ever talked to a lawyer, you know that answer is never going to be straightforward. But we're going to have to come down and nail some probability to it. And then, okay, if it were to occur that the judge or the lawsuit goes against us, how much would we be paying out? Is there a way to estimate? Sometimes it's clear, this is the amount. If you have punitive damage or something, it can range widely. So we're trying not to disrupt our P&L unless we know exactly what it is, okay? So again, with GAAP, it's probable and can be reasonably estimated. The second one that we're going to be talking about is the bond payable. Now, we're going to touch on this subject, but know that you will deal with these again in much greater detail and much more complexity in both your future accounting courses and in your future finance courses. But we're going to just introduce the topic, do some basic calculations, go through those basic journal entries. And then next year, you're going to have to remember that it's a lot more complicated than that. Okay. But in order to understand what a bond is, we know that it is a liability, and this liability is a company selling debt to the public for an agreed upon amount at an agreed upon interest rate. Okay. So if you've heard of that, it's basically like any mortgage on a house or anything where money is being exchanged up front for a future payment, and we're going to be making equal payments throughout the term until it comes to that amount. Okay. However, when we talk about interest, you can't talk about interest unless you've seen this risk versus reward. Okay. So bond payable is a debt, which means that there's a stated interest and a stated return. However, when I purchase that bond, the only way the company can make that payment is if they're still up and running. Now, in the event of a bankruptcy, I'm still higher up on the totem pole than an equity owner. So I'm in the debt, but yet not all of it's going to be realizable if they go into a bankruptcy and a lot of the assets aren't there. So what that means is there's risk purchasing this. I could just go to a treasury, get a stated interest and have no risk because I know the US government has never defaulted to date. But this company might not have been around for that long. Sometimes it's a stable company that's been here for 30 years, so the risk is going to be lower. Sometimes it's a new company trying to get out into a new market, and so the risk is going to be higher. When that happens, my reward has to shift with that. Okay. So the company is going to state an interest rate on the loan, and investors are going to compare that interest rate to this risk reward scenario and say whether or not that return is created. And with that, we have a few definitions that we're going to know. So the face value is what the company has decided, this is how much we're going to pay you sometime in the future, this amount at a set maturity date, which is the amount that that total payment is going to come due. And based off of that risk reward, comparing it to the interest rate stated, investors are going to decide on what's called a purchase price. Okay. So if the company's risk reward says, okay, I need 8% return, but the company's only issuing a coupon of 6%, then they're going to have to discount the purchase price to make up for that 2% difference that's going to be needed in order for that investment to be worth it to the company. On the flip side, if that interest rate is stated at 10%, then I'm going to be paying more for it, which is called a premium, because I'm already getting a higher return than what I've deemed necessary for my risk. Okay. So again, the coupon rate is what the stated interest rate on that bond is. And when we determine, we're still going to make the interest rate so that way we're not having to deal with coupon or having to deal with compound interest. So each period I'm going to pay off the interest, which will be based off of that coupon rate, multiplied by the face value, multiplied by how much that time period has elapsed. Now, I didn't want to repeat this formula, but when we get into the simple short term, we're going to use this same formula, except we'll just use that interest rate that's stated because it's short term, so we don't need to worry about a discount or a premium. We're going to make a straight calculation on calculating if it's a discount, this number is positive when you take the face value minus purchase price. And at this point, we're not going to get too complicated. We're going to tell you what the face value is and the purchase price. And again, future classes, you'll get it more complicated and you'll have to calculate these yourself based off of that difference. But for now, we'll give you those and just create those journals. So what that means is the value that I'm going to pay in the future is different than the value that I'm getting today. So when you think about your journal entry, your cash is going to go up, so you're going to debit your cash. This liability is going to be credited at some point in the future. You're going to have to pay this amount, but those are going to be different. So we're going to have to balance that entry by doing the discounted premium. So you can use this formula, or you can just balance your journal entry, okay? And so the discount is decreasing a liability, so that's going to be a contra liability account. The premium is actually increasing that liability, and so it's going to just be a straight liability account. So credits here increasing premium, debits increase the discount. And when you get to this point, realize at some point in the future, this is the amount we have to then pay. So we're going to amortize either this discount or the premium. And for now, we're just going to straight line amortize however much this is, divided over how many periods we have. And each period, we're going to reduce this amount so that when we go to pay off this value, we can make just one quick entry. Okay, so just like with the PP&E, the face value of the loan will stay in one account, and we'll have a separate account to increase or decrease it based off the purchase price. And we're going to reduce that second account until at the end of the day, we only have the face value. Okay. So when we have a bond, the actual interest expense is going to be different each period because we're going to have the cash payment, so that's based off of the coupon payment, plus or minus this discounted premium, okay? So in our examples, we'll get into how's that actually calculated. All right, so again, we're going through each of these scenarios. We create that bond, so the company's issuing this bond. So we're getting cash, we're getting a debt, and we have to balance that entry. In this case, the debt is higher than the cash, so we were giving it to them at a discount, and we now have this contra liability account. Each period, we need to recognize the payment made, which is going to be the face value multiplied by that rate, multiplied by that period. So here, semi-annual is twice a year, so it's 6 months have expired over a 12-month period. So the interest rate is always going to be given to you at a per year, which is 12 months. So sometimes quarterly means there's 4 payments a year. Semi means there's 2. Could be monthly. In this case, it'll be 1. Okay, so we're going to have 6 months or half of a year. Multiply that out. That gets you your payment. We're going to have a discount here because the face par value is different than the purchase price. So that gets you the discount. We have 30 periods here because we have 15 years, 2 periods a year. So each period we're also going to recognize 9,500 of that discount. So it's the payment in this case plus the discount. Our total interest expense is the 62. So what happens is we have 30 payments of this amount. We also pay the par value at the end of it. So the total amount we've paid is this amount for that loan. We only actually borrowed this amount. So over the 15 years, the total interest expense that we were going to recognize is that amount. The cost of that loan is the difference between how much we've had to pay out versus how much we had to pay. And again, we're doing simple calculations here, so don't get too confused with time value and all of that. This is just the interest that's been recognized as the difference between what was paid and what was received. We have an amortization schedule, so we started out with this discount. Each period we knocked out 9,000. And so just for these 5 years, this shows you what that carrying value, so just like PP&E had a net book value, carrying value is going to be what that face value is plus or minus the discount. And when we record the interest expense, we're going to have to decrease our cash because that's the amount being paid. We're going to be decreasing that discount equally, so that way it's 0 at the time of the payment. And then we're going to record our interest expense. Expense is a debit. Discount is a contra liability. This is decreasing it. Cash is an asset, so that's decreasing it. Okay. And there you can see the calculation. All right, so again, this one was a straightforward liability, so we didn't talk about it much, but it's sales tax payable. So as you know, when you go to the grocery store, you have what you pay for the groceries or for the food at a restaurant or whatever you're making the purchase of, and they always tack on that sales tax, okay? Well, that sales tax that you're paying has no issue with the revenue that's being recorded for the company because they're just adding to the amount that they've earned this sales tax. They're collecting it from you, so the cash has that as part of it, but it's not their revenue because they're just going to turn around and send it straight back to the state. Okay, so when we do that, we have, this is the amount of cash that was recorded. We're only going to record the sales versus how much we actually earned. And the difference there, which is going to be just calculated straight off of the amount of the revenue times the percent of the tax. The difference there is going to go into a short-term liability account that we're going to call sales tax payable. And again, every time we have a sale, we have two transactions. We have the sale and we have the change of our inventory, moving it out of inventory. We no longer have that inventory. We now have cost of goods sold. So every sale has two entries. And then when we go and that sales tax payable is just a turnaround. So eventually we will pay back that cash to the state and remove that liability at that point. Okay, it's pretty straightforward. Same thing, we have another example of the sales tax payable. Here, the second example is on unearned revenue. We've talked about unearned revenue before, but this is when we're going to receive cash before we've actually dealt with the work. So when we've done that, at that point, we create an unearned revenue, a liability account. And after we've done the work, we need to clear out that revenue. And so we're going to decrease that liability, increase the revenue at this point. All right. So again, we're just recording the cash sales. The sales times the sale tax rate gets you that. That's how much cash we received. And we have one transaction, we have a sale. Then we also have a movement of our inventory. And the next one, they just tell you this is how much they've earned of previously recorded unearned. Okay, so at the time we did the unearned, we increased our cash, we increased our unearned. Now we're decreasing our unearned because we've done that work now. Here we're just doing some more repetition. So maturity date of the three notes. So maturity date is again the date that that payment is due. So we have three notes here. They tell you the date that the note was started. They tell you how long that note is. So you're just going to add that many days to each of these. This one's credit, so that's not a note. Accounts payable, so we borrowed here. So July 8th on 120 days. Then you have Wells Fargo, November 20th on a 60-day. So that's the first time is just discovering the maturity date. You add that many days to today. You can see that May had 90, NBR had 120, Fargo was 60. Second part was calculating that interest. So again, here's where it's just going to be simple interest. So you take what the principal is, multiply it by what the rate is. That rate is given on an annual percentage. So they tell you how many days those are. So you have to divide how many days those are. For quick calculation, they tell you just assume there's 360 days in a year, and that just makes it a little bit easier to deal with these numbers. Straight multiply gets you what the interest expense is. So that's what the interest due at maturity is. And the interest expense to be recorded at the end of 2016. So this is how much in total. Now we're only talking about in 2016 for this year. So that's the principal value of the Wells Fargo multiplied by the percentage, and how many days in this year out of 360 did we have? And then same thing in 2017 is the residual of that period. So how many days left in that loan multiplied by the rate multiplied by the principal. And then we have just some, we're purchasing inventory. So another short-term liability is accounts payable here. So just like we would have accounts receivable, not all the time is there cash handy. It's easier just to let the bank, so they'll send you the invoice. That creates an accounts payable. So the reason we received this asset is because we now have to pay that cash. When we pay that cash, we're going to decrease it. Sometimes we'll convert that accounts payable to a note if we ended up purchasing a large amount early on to pay for a full year's worth or something like that. We'll convert that AP into a note, and then that's similar to the bonds and all that. Here we're just getting straight cash for a note. We've gone through how to calculate interest expense for a note. And this is, so when we pay out cash, we're crediting cash, we're removing the liability, we're recording the interest. Anytime it crosses a period, we'll just record the interest. We're not going to pay it until the principal on these short terms. So that's just going to go to interest payable until that happens. Okay? And then once it happens, we have to record the interest for that period. We have to remove the liability. We're reducing the liability that we had set up at that December 30th reporting period. And again, this is how much we calculate as the total maturity value. Okay. Pretty simple calculation, so I'm going through it fast, but if y'all have any questions, just let me know. We can go through in more detail, but the formulas you just run through again. So again, we're setting up an unearned. They're paying us in advance for work. We haven't done the work, so we can't record the revenue. That is increasing our cash, so that's going up. And once we've earned a portion of it, when it's time to report our numbers, we'll decrease that liability and then record the revenue at that point. Here, they don't mention inventory or cost, so we assume that throughout that period, whatever cost was coming was going through that. They don't mention it, so we won't report anything. We've talked about how to calculate the cash and the discounts. So you just go through the same. Proceeds is that principal times the interest times the period. Discount is the difference between the face value and the cash. That price. So here we're using the table value. So the par value, let me see exactly what this question. Okay, so here we're telling you how that difference is coming up. So again, that risk reward, we're issuing it at 10%. the market has determined that based off of risk reward, we should be earning 12%. So when we go through these calculations, we're going to use that, and instead of you doing the calculations, they create the present value tables in your appendix of the books. What we're going to tell you is that the fair market value based off of time value of money has a factor of this amount given the maturity date, how many periods, and the 12%. So this is going to be based off of 12% at the par. The interest payment is based off the 10%. So that is how the present values are calculated. And so again, we use two different tables, one for the principal payment at the end of the date. So this 210,000, we need to determine what today's present value is using one table. And then the interest payments are made periodically. So that's an annuity due. So you're going to use the appendix for the annuity due to get you a table factor. Multiply those out. The difference between what the selling price was determined and those two, the par value becomes the discount. Okay. So here they told you this is what the sell price is. We've recalculated how much cash we're sending out the door, and that's going to get you the price of the bond. Because the price is going to be the present value of the 12% needed return. Small amount of rounding so we can assume it's reasonable. Here, just straight calculating the number of payments. And so you can tell par value is 590,000. Semi-rate of 4.5, total payments, and it's going to be issued at a discount. And the discount is because we're only paying 9%. They should require 12%, so we're going to pay less to make up for that difference. Again, the present value of the principal payment plus the present value of the annuity of that interest, multiply those out, gets you the present value of the bond. So we're only going to pay this amount for the bond. This is the amount that will be paid at the principal. So that difference is the discount. And that's how we calculated that out. Okay, so what this means is that for every $100, we're selling it for 126 and 7/8. Okay, so you have a par value of 390,000. So you divide that by 100, multiply it by the 126.78. That gets you your cash proceeds. So the way that they say it is for every $100 of the par value, we're going to pay 126 and 7/8 is how they measure the interest. So you multiply those two together. This is how much they're willing to pay for it. And we're going to say there's 20 payments of the coupon amount plus the par value of the annuity maturity. So we're totally going to get this much in cash. They borrowed only this much, so the total interest expense is the difference. And the interest expense here, the interest expense will always be what the market rate is multiplied by that interest, by the par value, because the discount or premium gets you to the market rate, which is why you're able to use a straight calculation there. You can also do it by taking what your payment is going to be plus or minus the amortization of that premium or discount. And here's the contingent liability again. It's not probable, so we're only going to have to make a disclosure, okay? And what that means is that because we don't think it's going to happen, we're not going to impact the actual financial statements, but we do have a duty to inform our investors that there is a pending lawsuit and this assumption may be wrong. So we're going to disclose it in the notes, and that's that lengthy section. If you've ever seen a 10K, your financial statements are 4 pages of pure numbers, and then all the disclosures is about another 30, sometimes 200 pages of just details of the assumptions that go into that number. And as you can see, each week we're learning more assumptions, more estimates. All of this has to be disclosed to our investors. We're only going to disclose of it if we know it's not that probable, okay? Also, if we think it is probable, but we can't reasonably estimate the amount, it's not going to do us any good to guess, because then again, we're still going to have a distortion in our numbers. We're not going to distort our numbers twice. We'll wait until it can be reasonably estimated or until it's already finalized, and then the estimate is how much we pay. Okay? All right, so that's all for week 7. Good luck, and I will see y'all last week for the final.